Hope you had a good lunch, and I saw that I didn't see them serving alcohol, so you'll probably make it through the hour's session. This breakaway session's on capital racing and new debt, cracking the funding code, and I'd like it to be a fairly relaxed, informal, and interactive session. So what I want to do is get through three key topics, which where is the funding coming from, dig into equity, dig into debt, and then I'd love to open it to the audience where we can actually ask our panelists a few questions, the things you'd like to take out of this session, and feel free. But if we can just keep it to the panelists for the time being. My name's Rob Hersov. I've lived 31 years out of South Africa, came back 7 months ago, and when you have a New Zealand wife, you've got to go to Cape Town, but I spend pretty much every week up in Johannesburg now because the action really is here. And the rest of Africa. My businesses are Invest Africa, which is a private members club for investors in Africa. We deal with private investors, family offices, funds, institutions, and corporates. And we focus on Washington, New York, London, Geneva, Dubai, and increasingly Johannesburg and Cape Town, because those are the capitals of Africa, and that is really the foreign direct investment looking in, including South Africa into Africa. The second business is African Capital Investments, which is our fully regulated UK merchant bank. We do 5 to 7 mandates a year, and we interact directly with foreign capital. So I guess my hat today is, foreign money coming into Africa. My panel is made up of a very famous developer, Mike O'Malley, who's a director of RMB Westport, Kapil Jobanputra, who's with Standard Chartered Bank, so he can give us debt and equity, top down. Mike, you're bottom up, I think. Prej Nagan, spelt correctly, who's with the Johannesburg Stock Exchange, so he can talk about liquidity flows and also what's happening on an exit scenario and where the money's coming from. And then Colin Rezic, and as you know, Colin's been in the African market relatively recently over the last 2-3 years with mezzanine product, so I think he's going to be wearing the debt hat today. Is that right, Colin? What I'd love to do is have everyone just introduce themselves. We've got an hour to go, so if you do 2-3 minutes. Mike, do you want to kick off? And just tell us what you've been up to over the last few years and maybe kind of where you're heading.
Sure. Thanks, Rob. We are an investment and development fund, private equity fund. We've been busy in West Africa predominantly for 10 years now. We, as individuals, have been busy on the continent for a much longer period than that. Our business is fundamentally commercial development, retail, office, industrial. In these fairly interesting times, we are finding the need to branch out into some alternative sub-asset classes, which are pretty interesting. Our countries of interest are Nigeria, Ghana, Angola, Ivory Coast as core territories, and then we are moving slowly and cautiously across to the east to get ourselves some diversity. So we're in our second fund now. Both funds are roughly the same size, between $250 and $270 million. And we have a policy of creating offices in country to make sure that we pick up the local flavor, that we're able to operate effectively, that we understand what's going on. And then we have a corporate back office, administrative office in Johannesburg. So my particular expertise is on the development side. I can talk about equity, can talk about fundraising or lack thereof. And when I saw the title being equity, fundraising, and debt, I thought, well, this will be a quick discussion. 5 minutes and we're out and we can go drinking. But that's probably not the case. So that, in a nutshell, is us.
Great, thank you. Prej, do you want to tell us a little bit about what you're doing in JSE?
Sure. So thanks, Rob. My name is Prejilin Nagan. I head up primary markets at the JSE. The role of the team really is to originate listings for the JSE across all asset classes, debt and equity, as well as our structured product platform as well. Just interestingly, the property sector has been a great contributor to listings on the JSE in recent times. An interesting stat, since 2013, it's accounted for sort of 20% of all listings on the JSE come from REITs, and a further 20% come from real estate investment and services companies. So a real good contributor. Our most recent REIT, Harriet, listed, and we have representation from that company here as well. So our job has been relatively easy over the last few years because it's been an extremely popular asset class for obvious reasons in the local context, the tax benefits and the fixed income nature of a REIT in terms of its 75% distribution. But certainly, as I see it, a lot of opportunity for the product on the rest of the continent and locally as you look to specialize, or the opportunity to specialize within REITs away from just your normal commercial property into more residential REITs and so on. So those opportunities do exist, and very excited about it.
And do you want to give us a little flavor of the non-REIT property companies and what's happening in that sector?
Sure. So interestingly, if we look since that 2013 timeframe, what you can see is actually less non-REIT property companies listing and an increase in the REIT property companies listing. I think that's a function of, as I've mentioned, the underlying fundamentals of how a REIT operates, making it attractive for investors. So yeah, I think that the REIT opportunity will continue in South Africa, and hopefully we can build it out to the rest of the continent.
Kapil, Standard Chartered.
Thanks, Rob. So I sit out of Dubai as part of the Middle East and Africa real estate team. The team is part of a global franchise. We have about 80 bankers globally, covering most key markets in Asia, Middle East, and more recently Africa. The Africa business is relatively new. It's about 4 or 5 years old. And the idea was to bring our real estate financing capability into markets where we're already present as a bank. So in Africa, we cover 7 key markets: so Nigeria, Ghana, more recently Cote d'Ivoire in West Africa, Kenya, Uganda, and Tanzania in East, Botswana, Zambia, Southern, and then selective names out of South Africa. So globally, we do look at financing solutions across the capital structure. I think with Africa, our core requirement is actually in the development finance and sort of investment loan space. So we've closed a number of deals across our markets, but obviously treading carefully in a conservative manner and taking it. I think we're very much a sponsor-led strategy.
And talk us through a little bit Standard Chartered balance sheet and private equity approach. I know that's a different arm to yours, but where do they stand with regard to African real estate?
Yes, so we do have a fairly substantial private equity team, which is Asia and Africa focused. It does sit separate to us. Unfortunately, I don't think they have much real estate appetite at this point for Middle East and Africa. But certainly in Asia, we have a very substantial business of partnering with key developers and going alongside with them. So I think in time, the private equity side of the business may extend to Africa, but I think probably a little while away still.
Okay. Colin, you just came back from raising a lot more money. Tell us about what's going on in Vantage.
Good afternoon, everybody. My name is Colin Rezick. I'm one of the founders of Vantage Capital. We started more as a small private equity technology fund, but very quickly moved into the mezzanine space when we saw, it was around 10 years ago, we saw the opportunity in what we call the middle missing part of a funding structure. So mezz is really between the debt and the equity. We have raised 3 funds. First fund was around R1 billion. Second fund close to 2 billion, and the third fund is around 4 billion rand. Our first fund was only for South Africa. Our second fund was 35% into Africa, and that's where we did do 1 or 2 property deals. And our third fund is around 60% for Africa. So there is this drive, I think, for funding in Africa. We've seen the opportunity and our funders have also seen that, and they are willing to back us. The other side of the business is on the renewable energy side. We have 2 renewable debt funds. First one's around 2.2 billion, and the second one close to 3 billion. First one's fully invested. Second one, when Eskom, I think, decides it's time to sign off the renewable projects and do the right thing, then I think we'll have a lot of uptake on the second fund. So it's really, we have around 10 billion under management, but focus more on the mezzanine and the debt side. And property is, I think, a very good asset class for our funding, because you always have the equity partners who spend a lot of money on the property and on the services, but then run out of capital. And then the debt guys are very conservative and only want to start giving you the debt once you have either pre-let or pre-sale. And so it often creates that gap in between, and that's where we play.
Okay, great. So what just for those people who've arrived, what we're going to do is do this in 3 phases. Talk about where are the deals coming from, what are the attractive deals in which countries. Then we'll talk about equity, then we'll talk about debt. And then I'd love to have questions from any of you. So we'll try and structure it that way so you can get out of it what you want to get out of it. So let's talk, Mike, if you'll go first, talk about deal flow. Where are the deals coming from? Where the attractive markets? What are you seeing? Is there a plethora of deals, or is it still, do you have to shake a lot of trees?
When I look at our competitors in the room, let me tell you, there's a plethora of deals. They just come in through the door all the time. No, Rob, on a serious note, deals are pretty hard to find. The last couple of years, there's no doubt that the West African space has come under increasing pressure. Good quality deals are few and far between. There may be some distressed opportunities which are coming across all of our plates at the moment. But I think that quality deal flow is hard to find. And mainly because you look at an opportunity, you know that you're going to have to pre-let in order to get your debt. And what's quite gratifying for me is when I see Selwyn Bleeden, Gerard Zili, guys who I've really imparted all my debt knowledge to over the years. And now you guys are actually quite competent in this space. No, because I'm over it now. But really, as equity developers, to a large extent, we're driven by what we are able to put together as the capital structure. And then you've got to try and find a project or a set of projects that fit into that mold. So I think West Africa, difficult at the moment, but there are pockets that you can draw upon. I believe East Africa, and we've been trying to get into it for a while, there are maybe more opportunities center and east, but I think it's still a difficult environment all around.
And do you find you're competing against local players increasingly, or is it the same as before?
Yes, I think just as much as before. So I would guess that local players have always been there. I think that they've become stronger. I don't know if more local players have actually stepped up to the plate. I think the pressures that we've seen in our jurisdictions, in fact, have eliminated quite a bit of the competition. So I think that the smaller operators and the ones that were maybe less well secured have disappeared or have taken a back seat. And you found that that your competitor base has actually thinned out quite extensively over the past 2 or 3 years.
So do you think, deal flow, quality deal flow is more of a challenge, or funding?
I think that there's
Today.
quite a lot of equity available for good quality deals. I think it's the deals themselves that are not necessarily presenting themselves as they were 5 years ago. So I would say more the latter.
Capel, do you want to? You must see a lot of deal flow. Is there enough quality?
I think our biggest hurdle is actually not so much deal flow, but deal size. So as senior lenders, we're very keen to to hit the right sponsors and the right types of projects in the markets that we play in, and back our clients and specialized sponsors in these markets. But what tends to happen is, we do operate relatively small teams. Whilst we do have balance sheet available, we typically do have minimum deal sizes, so around the $20 million mark, which is an area that we don't really play in. And I think probably there is a space in the market for that smaller deal size. And I think the opportunities between the $5 and $15 million mark are plentiful. No, on the debt side. So equity side, we actually, we have a very limited scope in terms of equity in Africa. So it's very much a debt-driven strategy.
Colin, you want to talk about deal flow, quality?
Yeah, I think we have a different approach. I think there is deal flow, but we go and find deal flow. We have 15 professionals, including myself. We all go out to the markets. We cover Senegal, Ivory Coast, the whole Francophone Africa, Tunisia, Morocco. We cover Egypt. We cover Rwanda, Kenya, Uganda, Tanzania, Botswana, right through. So I think, and we have Moroccans working for us. We have Nigerians working for us. We have Ghanaians working for us, Kenyans. And we get these people out to those markets every month. And I think so we go and find and hunt the deals. So that's why we are finding a lot of deal flow. And funny enough, of all the industries, we're finding the most coming from the property sector. So, but I think remembering that you don't do all the deals. There's a lot of deal flow, but you've got to look for the right sponsors, the right quality, and also craft the right deal that works for you and the sponsor. And often there's that impasse, which does sometimes deals do fall apart.
And Mike, you mentioned distressed. You said you do see quite a lot of distressed. Give us some examples, and then I'd like to discuss brownfield versus greenfield. Maybe you want to say a little bit about that too.
Yeah, if you looked at our business 3 years ago, we actually wouldn't have looked at a distressed deal at all. So it was just greenfields. There was plenty of it, and there was no need to actually look any further. But you look at a city like Lagos, you look at a city like Accra, 2 projects that we're busy with now, one in Accra, one in Lagos, where local developers have both our office projects. One got to a point where they were maybe 25% of the way through their construction and got into trouble, and everything stopped, turned to us, and we provided some assistance and obstructed a deal where the more they lease, the more we invest, and at the end of it, it should actually work out fairly well for us. Another one in Lagos where the project is fully complete, 100%, and the developer just never kind of got around to looking for tenants. And then the banks, I think Stanbic is one of them, came knocking on his door. He's turned to us, and again, we're crafting a deal with him which will alleviate some of his pain, but it's a good deal for us, and it will kind of be in step with the leasing progress in the market. So we're seeing some of those. What we're not seeing is cheap land being made available. So the value of good pieces of property have not come down in the markets we're dealing with. I think the more marginal pieces of land have, and you can pick them up a lot more competitively now. But Nigeria and Angola, both under quite a bit of pressure, land prices haven't moved at all.
And can you make money on brownfield? Is there much brownfield activity in Africa?
Yeah, you can. And I think a lot of it comes down to the structure of the deal. But yes, there are some distinctly good opportunities in brownfields.
Yeah, we've done both. We've looked at greenfields, we've looked at brownfields, and I think in Africa one needs to be very aware of, the situation. I think as South Africans we tend to be impatient, we tend to want things to happen quickly. But I think you need the right sponsor, and I think in Africa you need to find the sponsor without reputational risk or damage, because there are a lot of the wealthy people out there who do have some reputational damage. So you need to sort the sponsor out. I think you need to sort out the project itself. Does it make sense? And for us, do we have security on the property? Do we have outside security? Do we believe in the property? Do we believe in the timelines? We always extend the timelines and the costs and put those into our models. The currency is always an issue. We put that into our models, even though a lot of the tenants pay in dollars. And one of our companies that we supported are here today. Very happy to say, is Landmark from Nigeria. Great development on Victoria Island, PwC clients, Hard Rock Cafe, Chiro Restaurant, and I think they're really going to make a great move in that. So often we will, like in Simba in Uganda and UAG in Namibia, what we did is these businesses have existing portfolios. So they either have offices or hotels, and we help them to build their next hotel or their next office block. So I think, so we play in both sides of it. We're funding the developers of the Horo development above the Gautrain, 200,000 square meters there of mixed-use development. And, that's about to kick off, but that is a first-class development, and I think you probably all know about it, and I think that we're looking forward to seeing some good returns. But there's a typical example where the banks wouldn't give them money. They didn't want to sell equity. They wanted to try and maximize equity. So Mez, played well. We have first lien on the property. So for us, it's a good risk-return investment.
Fred, do you want to say anything on deal flow? Or?
No, I mean, from my perspective, I think when the opportunity for equity capital market or debt capital markets comes up, these companies are generally well established, well developed. They've got the right tenants and so on in. But just a couple of comments from my side is that, and Mike's pointed it out, I think from a South African institutional perspective, you're looking for certain characteristics in the properties or in the REITs that you're going to invest into. You want to have low vacancies, you want to have good quality tenants, and those features, it seems to me, may exist in other jurisdictions, not necessarily in Africa. So as the teams and the ecosystem of people that go out to try and originate these transactions, there's probably a paucity of those well-established, well-tenanted sort of properties on the continent. So again, to my mind, I think the point has been made before, but it's going to be less assets and a lot of money chasing them.
So when you look at the macro story of real estate development and urbanization in Africa and population growth and country by country or across the board economic growth, it's a very compelling story. And when we meet international investors, there's a real appetite to come in and invest in the real estate game in Africa. So it seems like there's a wall of money waiting to come in, and yet, it's not coming in as fast as you think. Maybe there's the default of investing is you invest with more established fund, an Actis or an Abrage, or you follow a developer like R&B Westport. And, maybe there's a lot less equity project by project. Kapil, will you give a view on that?
Sure. From our perspective, and I think we have a different perception because we have this global network through the bank, Standard Chartered. So we do often approach a number of our clients who are investing internationally, and we receive reverse inquiries to understand the African markets in more depth. I would say around 2 years ago, we saw a number of high-quality institutional investors looking at Africa, putting people on the ground, really, really gung-ho about the whole African story. Unfortunately, I think the last 2 years have been quite difficult, and we've seen a lot of those investors and a lot of that capital come away. I think with the likes of Actis and R&B Westport, investors are much more comfortable placing money with well-established, well-experienced funds who have the experience and expertise. But I do feel that investors looking at direct investment are now double thinking their aspirations in Africa, and they want to see a period of stability before they decide to go in and really put equity in. So at this stage, I think the majority of investment has been indirect as opposed to direct.
And seems like there are large pools of capital now looking for large projects, which are few and far between. So the weight of money is maybe forcing some slightly riskier investments to be made. I don't want to point fingers, but I'm not sure I wanted to build an 80,000 square meter mall in Nairobi. From what I hear, 25,000 sounds about the max you'd want to do. Hope no one's upset with me on saying that. Mike, give us a view on that. Wall of money, paucity of deals.
Can't see the wall of money. I think what's happened is there's been a correction. And if I look at the fundraising experience we went through 2010 to 2012, Fund 1, first-time fund, pretty difficult for us to get cracking, but everyone was willing and enthusiastic to hear the story. Most of the funds came from North America at that time, very little from Europe, but big enthusiasm, could see the growth story. And I see one of my colleagues, Louis Deppe, here, because we did a project together in Lagos, and Louis said to me, I think it was 5 years ago, he said, listen, this middle class phenomena, watch it. There is no middle class. Yeah. And I said, rubbish. You know, our thesis is based on this burgeoning middle class. Louis right. The middle class story has turned out to be pretty thin. So, and everyone pretty much understands that. We seriously overestimated the strength and the depth of the middle class. It hasn't happened, it will happen, but there's a kind of a very slow growth rate towards that strong middle class that we were all hoping for. So we've all had to temper our expectations. When Fund 2, when it came time to raise Fund 2 in 2016, it was a much different story that we had to tell. And the audience had thinned down tremendously. It was really difficult to talk about Africa at that time, and it remains quite difficult to do so today. So I don't think there's a wall of money. There's some money, and there are a number of us who are kind of looking for good quality projects to deploy some fairly serious chunks of capital. But the wall of money, in my view, is not out there waiting to come in at the moment.
Okay, equity. Let's keep going on equity. If the equity is looking for somewhere to go, I mean, it can go into the public market. So how have those stocks performed? And not just the REITs, if you can cover the whole universe.
Sure. So I think if we look at sort of the equity capital raising since 2014, it has been coming off slightly. But if we look at some of the more recent listings and additional capital raisings on the JSE, they've been very successful. So if we look at international investment on the JSE, sort of 40% of the JSE is actually owned by foreign investors. So there is appetite certainly from all around the world, at least in terms of their investment into South African stocks. For me, an interesting phenomenon, obviously, is the increasing amount of interest into Eastern Europe and, well, I guess Europe in general. Some of the listings that occurred on the JSE last year included listings of companies with assets located in Eastern Europe. And you've got to ask yourself, if you look at Poland and its, sort of 4% GDP growth over the past few years and its population size of 30 odd million people, that's comparable to a lot of stats for countries throughout the continent, but not as much appetite for investment into those countries. And to me, the key feature there is going to relate to the FX currency, to the FX risks around that, the hedging costs. So, for me, certainly, the features of the African market is beset to some degree by those currency risks. And another key feature around the African markets in general would be transparency. I think as legislation develops in other jurisdictions, you might find that the potential for further capital market participation increases as well. I think investors want to have a better sense of what's happening within those companies based on rules that are available in those jurisdictions.
So the equity market's relatively well developed, and the whole property business in Africa has really been built on equity. Equity's been the basis for it. But let's just discuss currencies for a second. I mean, how do you abrogate the currency issue across Africa? Is there a standard approach other than having all your rents in dollars?
Yeah, look, it is a big issue that I think all the banks in this room are facing. Typically, the view is that I think for an investor to borrow in local currency doesn't necessarily make investment sense from a return perspective. So the idea would be to structure, developments and deals so that the inflows are US dollar and they borrow in US dollar. Unfortunately, because of that, also their rents will be their escalations would be, indexed to the dollar rates. I think we're still more comfortable looking at developments and lending in dollars. We do look at local currency as well, but then I think the investment sense, as I said, is a lot more challenging. So the volatility is a big issue, and ultimately, whilst you may have receivables in US dollars, you've got to look at the underlying capacity of the tenant to pay in US dollars. And as your deviation increases, then I think you've got to then take a view: are you actually taking currency risk? And I think then that relates to more conservative structures in terms of your loan to value and your cash coverage ratios and the way you typically structure deals in these markets.
So let's gravitate to debt now. Colin, maybe you can dive in here because, in some ways, if equity has been the dominant financing source, mezzanine is a competitor to equity, would you say, or at least enhancing the balance sheet? Give us a view on where the market is right.
I think mezzanine, even in South Africa, is still relatively unknown. And we've been the only player, I think, for the last 10 years. I think this year Ethos have raised a fund. I think they haven't done a deal yet. There are one or two other institutions. I think Ashburton are looking at it. One or two others. But so we've been lucky. I think competition is coming now. But I think mezzanine, even in South Africa, has a long way to go. And it's more education. It's not that the deals can't be done, they can, but it's to educate the sponsors what mezzanine is and how does it benefit you. And probably the biggest benefit is the lack of dilution, where you don't have to dilute. You bring an equity partner and you've got to sell 40% of your business or in property of a project, where if you can gear it up and it goes well, you keep the lion's share of the equity. So we're now trying to relay that into Africa, and it's working. I think it's working because Africa, even more so, family businesses, the African culture, people don't want invasive partners coming from the West and telling them how to do everything. I think they want to still be in control of their business, but they need that funding to expand. So I think from a mezzanine perspective, no doubt there is opportunities and we're seeing them, and that will grow. I think from a senior debt perspective, the banks will always play. I think local banks will play, but local banks are quite fickle in a sense. They either overlend or underlend. They never quite assess the risk and the right risk. So they either think, no, this is a great project, give them too much, and then the guys come running to us and say, oh, the banks are going to call in their loan, can you help us? And there's nothing wrong with the project. So, and I think the second thing is banks have Basel III, banks have, other sort of constraints. So I think the non-banking institutions are going to play a big role. We're starting to see it here where you have the bond market and it's asset managers who are actually funding the debt. And I think that is going to also move into Africa. And I mean, we've seen it.
Some examples of non-traditional lenders.
Yeah, well, yeah. So you have funds, you have what we call global credit funds. So we looking at that, and that's what we're actually doing on the renewable side, where we invest with the banks, alongside the banks, and even compete with the banks in giving debt. And we can be a little cheaper because we don't have the liquid reserves and Basel III and all these things. And our investors are pension funds or funder funds or asset managers. So we're seeing it in the renewable side. It's going to happen and we want to move it into the other parts of the industry. And it's the big ones that are lacking. It's your infrastructure and it's your power, and then it's your property. And I think actors have earmarked and seen property as a separate asset class that demands funding for its, that asset, for that sector. And I think you've heard of the Abrages, you've heard of Helioses, people like that, people like ourselves who's starting to move into call it private credit. So we'll once again, like we're doing in renewables, compete with the banks. So you'll be able to come to us, we'll do senior loans. We'll be less covenant light. We'll be able to roll up where the banks need to amortize. We'll be able to structure it differently. You can have periods of grace for 2 years because a project might need 2 years to get off the ground. So I believe there's going to be a big wave of non-banking finance in this market. But keeping in mind the market is also going to grow. Because if you think of the lack of infrastructure, proper property, and we know that the shopping centers have taken strain, some of them, I think too many in Kenya, Nigeria, I think some of them may be too big, or the rentals are too high, but we've got a lot of demand for smaller shopping centers, maybe 8,000 square meters, or what we call suburban shopping centers, or strip malls. I think that hasn't even started in Africa.
So take an 8,000 square meter mall. What would the total cost of that be? And what percentage in a hypothetical balance sheet would be provided by MES? What's the ideal slice of equity, MES, senior, hypothetical?
Yeah, I think on the REITs here, I think you're talking more around sort of debt, LTVs, loan to value of, if you're conservative in the 40s, if you're not, you can go into the 50s or 60, but that's where it stops. We as MES will say, well, we'll go up to 70 or 80. So I think for MES, that's where it plays. For traditional lenders, and I think every African country is a little different. Some of the local banks are more bullish, but some are becoming very conservative. So I would say around the 40 to 50 mark on the senior, maybe 15 to 20 on the MES, and the rest it would be equity.
Capital, do you want to talk a little bit about the debt side now and what you're seeing?
Sure.
Non-traditional lenders.
Yeah, look, I actually completely agree with Colin's view there. If you look at who are actually providing finance across sub-Saharan Africa in terms of the lenders, you've got I guess, three categories. So firstly, you've got the local banks, and local banks have historically been very much relationship focused. We know this entity, we know this family, we understand their core business, and I think probably a little less structured in their approach from a real estate finance point of view. And obviously they have an important part to play, more in the local currency space. Then you've got the regional South African and more international banks. And these banks have specialist real estate teams. They structure deals quite effectively for real estate developers and borrowers. And it works much better for the underlying project. So the international banks and South African banks have been relatively aggressive, but there are constraints within this space as well. So from a Standard Chartered point of view, look, we have plenty of dry powder for projects, but we are constrained to geographies, certain countries, certain markets. We're constrained by leverage. We're constrained by underwriting standards, which are quite strict.
Constrained by terms. Are you getting beyond the plain vanilla terms?
So terms, obviously, they form part of our underwriting standards. Like tenor, for example, we're capped out at 7 years. We can take refinance risk. We can structure things so that they work from an investor point of view or a developer point of view. But really, I think the issue is that we have other issues such as, as you mentioned, the Basel regulations, PRA regulations. And as soon as we look at non-recourse, completely non-recourse, we're flipped onto a different returns model. And that really does hinder us. And then the third provider of debt are the DFIs, who I think play a really important role in this market. And they continue to be committed to the markets. They're there for the long term. They provide patient capital. They are, they're flexible, more flexible in their terms, but then they also have their constraints in that they are very much focused on projects which allow them to have that developmental aspect or employment and society type of value add. So I think all that said, there is still a huge space in the market for these mezzanine or private debt funds who may structure exactly the same as the banks in terms of being senior secured, but they are able to bank projects which the banks typically may not be able to look at. For example, sponsor is a very important part to us. So even if it's the best type of project and it makes complete commercial sense, if the sponsor doesn't make sense, we can't look at those deals. And that's where the private capital places.
And Colin, would you say the non-traditional lenders can move a lot quicker than the South African banks or the standard debt funding sources?
I think definitely. I think banks are traditionally known for dragging their feet. I think, we believe within 2 to 3 months we can have a deal done. Everybody thinks you can do it quicker, but depends how much information you've got, etc. I think banks would be double that. But I think not only are they quicker in their decision making, but they're more flexible in their structuring. I think they can look at things differently, they can structure things differently. As I mentioned, they can roll up, they can have back-ended stuff, there's a lot of ways to skin a cat. And
What's the quantum of non-traditional lending? Because traditional lending is enormous,
yes,
potentially. Whether we can release it or not is another matter. Where is non-traditional lending right now in quantum? Is there $1 billion available, 10 billion, 5 million?
no, I think there's, if you think there's billions, but the equity side, there are trillions. So I think it's very small compared to, traditional lending. So I think there will be a big move towards non-traditional lending. And I just hope the people who do it properly. Because if they don't, and investors who invested in those funds see failure, then it kills the market for everybody.
And what returns can an investor in a non-traditional lender expect over a 5-year period, say?
I think it's pretty similar to your senior debt lenders. And in South Africa, they'll get a 10%, probably a good 10 or maybe 10.5%, which in today's terms is a good return. Net of fees, yeah. Because these are those lenders charge asset management fees. So they charge, not like private equity, you charge 2%, they charge 50%, and there's no sharing in the upside, So it's very compelling for investors to give their money to these guys. And they can get a net 10, and they know these guys are active, and as long as they're the right team doing the right work. So I'm saying the non-traditional lenders are going to grow, and that's where the opportunities are. And I think that's where we as an institution are looking towards that type of, so just dropping the mezz down a bit. We'll still keep the mezz, but if we can drop it down, and then makes it easier. Integrate, if you're doing it together, the intercreditors are easier. People are dealing with one party. And they call it, in Europe and in the States, they call it unitranche, where they don't really say what it is or why or how is it split, but they say blended, I'll give you 60% or whatever at this rate, and that includes mezz and debt, senior.
Capital, I'm going to let you respond. Prej, one comment. Mike, I promised I wouldn't pick on you for debt, so I'm going to leave you for the second, unless you want to say something.
Yeah,
Quick response, and then we'll open up to the audience.
Yeah, I'm not entirely convinced that whilst I agree there is a space, I don't think they're going to take the position of the banks. I think 10% is not where the banks typically price at for dollar. They're way within that. And I think for an investor, I would say, to give an investor Africa risk at 10%, I think my personal view is that they probably would, that would be the minimum they'd look at. So I think that the senior debt providers and the mezz providers or private capital providers, private debt, I think they can work together going forward. And I think that is needed, and it's something that will benefit the market.
Prej, final comment on debt?
Sure. So I guess from my perspective, I think some of the regulatory burden that's being placed on banks at the moment also allows for more opportunity for debt capital market pricing to become a little bit more relevant, as well as some of the pressures that guys are facing in terms of longevity of the loans. I'm hearing, I think you just mentioned 7 years. That might be lower in some instances. So definitely opportunity there within the debt capital markets. And also important to innovate in the debt capital market. So, the JSE is launching in short order a green bond framework to also enable investment into any sort of investment which has a green element to it, which is particularly useful in the case of property development. And it will help crowd in an additional pool of investors, so investors who have as part of their mandate ESG and so on. So, as the debt capital markets or as the capital markets look to innovate, I think we can come up with even further solutions from a debt perspective.
Great. Maybe you can get SARS and SARB to help you wrestle back the crown from Mauritius. Guys, we're going to open the open to the floor. Anyone got any questions for our panel? Here we go. If you just tell everyone who you are, who you represent.
Hi, my name is Barry Cohen. I'm with 21st Century Communities from USA. I was wondering if there's been any effort to securitize collateralized debt instruments.
Securitization?
To date, I think it's a space which absolutely needs to evolve. To date, we've not seen too much in the securitization space. But I think in short, as the markets mature, as capital pools open up, I think that this is, the banks are well placed to be looking into this space and typically providing more securitization type solutions. But at the moment, not at this stage.
I think there's still a hangover from the American market in the 2000s. Yeah, I think you've definitely put a bit of a scare on that. But I think it's really around, the depth of the market and the size of the market. I think as it grows, I think it will start, securitization will start happening. I mean, we've seen a demand for it, and I'll give you an example in the renewable side, where we're involved in a few projects, guys are looking at refinancing, and in the renewables you have early stage, and then once it becomes operational, the risk is very low because your power is being produced, you have the Eskom as the off-taker, and then those become yieldcos, and the return drops right down, and I think that's what guys have started doing, is setting up these yieldcos, which is really a securitization on one project, but I think that will start happening where they'll do it on more projects. So hard to say when, but I think also it's a function of our economy. I think you need the confidence in the economy, you need the confidence in the, just the markets and the investors. Investors are very shy at the moment. They don't want small caps, they don't want risky investments.
They don't want long term.
Yeah, they're sticking to the easy stuff in these difficult times.
Next question. Anyone? Beat you to it by a split second.
My name is Jimmy. I'm from Yipa, and my question is towards Colin. What is your view on using an online property crowdfunding platform as an alternative way to raise capital for your small developments, property developments?
Yeah, I think any online or disruptive business that we've seen have been extremely successful in very developed markets. We've seen the Ubers and the Airbnbs, and even in the financial sector, we've seen that online you can choose a portfolio, you just have to put your risk appetite in, and it will turn out what your portfolio will look at. I think in a sense, we had, with the home market, with your what we call mortgage originators on the debt side, that was online funding of your mortgage or your home. And that was very successful in the boom times. In the tough times, they collapsed because the bank says, why must I pay an intermediary a fee? I'll stick to my client base and I'll use them, for business, and they're happy to do that, and that's what's happening. So I think in time it will happen, but I think it's probably too early right now, and I think the market needs to develop more. And once again, it's the confidence that, who's on the other end, and who's giving me money, and are they reputable? And whereas if it's the 5 banks, including Investec, you feel comfortable. But if it's somebody else, and you never know, they're out of business in a few months' time. So I think reputation is important, and just confidence in who's doing it. And then there's no doubt we have the technical abilities to set up these portals. I mean, we've seen Property 24 and all these things. There's no doubt I think we have that capability. It's just to get the sophistication of the market and the people to buy into it and feel confident that it's a respected third party they're dealing with.
Question here.
Hi, my name is James Nathan, and I'm from Jones Lang LaSalle. My question pertains to both the debt side and the equity side, and I was just wondering where you're seeing the largest spread across sub-Saharan Africa in terms of the cost of debt and the total returns of the various investments. And obviously that depends on the jurisdiction and the subsector within the real estate realm. But yeah.
Look, and I mean, from my experience, I would say I think that Michael can maybe speak better on the equity side. But I think on the equity side, everybody went in there with very high expectations in the beginning, all looking for the 25% IRRs. And from what I'm seeing is the people have tempered that, and it's looking more like the 15 to 18% IRRs. And Michael maybe comment, and then I can talk about the debt side.
You're actually quite right. So 7, 8 years ago, 20 to 25, even 25 to 30, and that has systematically been reduced. And I think now, anywhere between 15 and 20 is actually you're doing pretty well. And if we follow the Actis model, then we can get it down to, Louis, what, 5? But yeah, so I think you're quite right, kind of 15 to 20, but it's come down quite significantly.
Yeah. And then but remember, this is dollars, so you can't say it's, you can't equate it in rands. I think people are still looking 20 plus. And then on the debt side, also, if it's in dollars, so your local currencies, the guys, and it's all over the place, depending on which country. In Nigeria, it's probably 18%. I've seen it in other places into the 20s, but if you take dollar terms, it's more around I'd say 6 to 8% you can get in dollar terms. And we as MES obviously will be more than that because we take more equity risk, but we try and price the coupon around the 8 to 9% and then take some equity in the project to try and increase our overall return.
Dion?
Dion from Foreign Properties. We do a large-scale project in the Congo, and over the last 5, 6 years, speaking to people about financing in the Congo is absolutely a no-go. But what we've seen over the last 3 years is smartphones and electric cars needs cobalt, and a lot of it, 60% of the world's cobalt is coming out of the Katanga province, where we are. So we've seen a lot of Chinese companies taking up office space with us, housing, industrial space. They're piling all over us. When is the traditional banks and these people going to start looking at the Congo and recognizing there's a place like the Congo?
I think a long time.
This could be a short answer, yeah.
No. Look, I think we get asked this question all the time. There's 52 or 53 markets in Africa. We're actually only present in 8. And I think we recognize the fact that there are great opportunities in many of these markets, but unfortunately the bank strategy is much larger than I am. And it's very much a factor of where the bank is comfortable going in terms of its footprint. And whereas we only operate where we have offices on the ground and we have people on the ground and we understand those markets very well. So I think we will expand our footprint, and as a result of that, the real estate strategy will also expand, but it's something that will take some time.
I can comment there also. I think one must understand, nobody's got anything against the Congo, but you've got to look at what's happening there, and you've got to say, people like BAT had a plant there, were making a few billion, and the government decided, we're going to slap them with a 5 billion tax. They just closed the door. So everybody's scared that if you don't have the right laws in place, the right protections, that you can't affect your security, government can do what they want. You saw with Supergroup, they just, in Angola, I think 100 and something trucks just disappeared, never got paid for. While that's happening, you're not going to get your traditional bankers in there. Maybe non-traditional bankers will look at it, but they'll also be very skeptical. Yeah.
Just to comment on that, BAT moved out before harder came into practice in the DRC. I'm not batting for Congo. I'm just saying there's a lot of things that has changed for the better, like Ohara. We've seen companies like Glencore going into the Congo. We've seen many like ACI South Africa, their biggest. They own the biggest explosive company in the Congo, AL Explosive. They've taken up office space with us. There's many of those good examples out there. I think still people fly over the Congo, and even if Katanga province is more extension of Zambia, but people still think Congo is Blood River, or one of those things. And I think really the other Australians and Americans, and I would say definitely the Chinese is waking up and is investing heavily into the DRC.
Do a ease of doing business every year. And, you know, if in that ease of business, if Congo is doing all these things, it will start moving up on the ladder. And then when it gets to a certain point, then people will start including it in their sort of outreach scope.
Guys, one more question, if there is one. Or, all right. Well, thank you very much. Thank you to my panel. Very interesting. I think we almost cracked the code of funding. Thank you very much.